All right, well, hello again. This is Professor Sam Lanzafame. Today we're going to talk about payroll, and I just want to basically get into it by really just diving right into an example. So let's create some payroll data. Basically, we'll just make up a fictitious employee, and let's pretend that our employee is single and is claiming 2 on their W-4 form. In other words, when they got hired by the company, they had to fill out some new hire paperwork. And one of those pieces of paper is called a W-4. And that's what basically tells the employer how much to take out of that employee's paycheck for federal taxes. The employee, depending on the state that they live in, may also need to fill out a state form. The number that you put on the federal does not have to match the one that's on the state. So you can put two different numbers on the federal and on the state. But we'll just focus on the federal because anybody listening to this could be in different states. So we'll just focus our attention on the federal impact here today. So we'll pretend that our employee is single, claiming 2 on their W-4. And basically, they can change that information on their W-4 literally at least once a month, if not more than that. So it's not like it's something that's set in stone. So you can change it very often during the year. So let's also pretend that this person worked 42 hours, which means that this employee will be subject to overtime pay, which is a good thing. And the Federal Fair Labor Standards Act says that any employee that works over 40 hours and is hourly, they are entitled to time and a half. So let's pretend our employee makes some good money here and they make $20 per hour. So that would be their regular wage rate. Anybody have any idea what time and a half would be of 20? If you're thinking, well, what's half of 20? That's 10. 10 added to 20, that would give you 30. That is correct. So if you came up with $30 an hour for the overtime rate, you are correct. So let's just put that in here. $30 per hour, and this is the overtime rate. And we'll call the first one the regular rate. So in case again you didn't follow how I got the 30, I can take the number 20 and I can multiply it by 1.5, which is time and a half. So by doing that math, if I go 20 times 1.5, you notice I get 30. So the way you calculate overtime rate is taking the regular rate and multiplying it by 1.5. We actually did it differently initially, but we just kind of did it in our head. We figured, hey, what's half of 20? It's 10. So add 10 to 20. That's how you can also get 30. So let's write that down as well. So you can take the original 20 and then add it to the 10, and that will also give you $30. So whatever way is easier for you, go ahead and do. So again, we've got this one employee who is claiming 2 on their W-4, and they currently have worked 42 hours, and they get paid $20 an hour regular rate, $30 an hour overtime rate. So we'll kind of leave this information over here off to the side, and then we'll come back, and if we need to add anything along the way, we'll go ahead and do that. So when it comes to journal entries, there's a couple of journal entries that we have to do as employers. One is going to be for employee data, and the other one is going to be for employer data. But before we get to the journal entries, let's figure out what this person's gross pay is going to be. And the way you calculate gross pay is you take their regular pay, multiply it by their overtime, right? Or add your overtime in there, and that'll give you your gross pay. Then we got to take out deductions. So we'll talk about that as well. so that we can figure out the net pay. So let's go ahead and start doing some calculations. Let's go and figure out this person's regular pay first. And we're going to take the first 40 hours and we're going to multiply those 40 hours by the $20 an hour. And when we do that math, 20 times the 40, that's going to give us $800 for gross pay. Let's now also calculate overtime pay. This person worked 2 hours of overtime. And remember, we came up with that $30 per hour overtime rate. And if we do this math, 2 times 30, they get $60 of overtime. So this employee's gross pay ends up being $860. So now any types of taxes, deductions that come out of this employee's paycheck is most likely going to be based on this gross pay of $860. Okay, so what types of deductions does a typical employee have? Well, one deduction that we definitely have is income tax. Federal, and depending on the state you're in, you may have state income tax. We'll just focus on federal. We'll have federal income tax. And the way you calculate federal income tax is by a table. And in order to help us do this, I have basically put in a table here that I just downloaded from the IRS, and website. And this is basically coming from publication 15, the Circular EE for employer. And we're going to use this to help us figure out how much tax we should take out of this person's paycheck for federal purposes, for federal income tax. So how do I use this? Well, if you notice over here it says, and the wages are at least but less than. And then you have from 0 to 10, and above that it says, and the number of withholding allowances claimed is. So basically, once we know this number and we know what the wages are, we just kind of connect the dots and figure out where the column and the rows intersect. So let's kind of remind ourselves what we have here. Our employee, if you recall, is claiming 2. So 2 was the number that we have to look up in the chart. So claiming 2, let me highlight that in green. And then we also have to look up the person's gross pay, which I'll also highlight in green. So these are the 2 numbers that we need to help us figure out the person's federal income tax. So 2 and 860, withholding and gross pay. So here is column 2, 0, 1, 2. So we're going to go down here till we find 860. And we look across here, I see 860 twice. So I see from 850 to 860, and I see 860 to 870. Let me blow this up just a little bit here so you can see a little bit better. Okay, so let me try to keep the title here. There we go. So now it's like, which row do we use? Well, here's where that column headings come into play. It says, and the wages are at least but less than. So if we go to this one that says 850 to 860, is our 860 gross pay at least 850? Yep. But is 860 less than 860? No. So that is the wrong row. So that means we must have to use the 860 to 870. Is 860 at least 860? Yes. Is 860 less than 870? Yes. You have to answer yes to both of those questions. So now that we're on this row, we're going to read across, and it looks like $91 is how much is going to come out of this person's paycheck. Let's blow that up a little bit here in case you're having trouble seeing it, but it is $91. Okay, so let's go back over here and we're going to put $91 as the amount for federal income tax. If you are in a state where state income tax is taken out of your paycheck, you would go to your state's income tax table and basically go through the same format. Okay. Also, coming out of our paychecks is Social Security and Medicare under the umbrella called FICA. So we have FICA, Social Security tax, and we also have FICA Medicare tax. Social Security is taxed at 6.2% of your gross pay. So let's do that calculation. So 860 multiplied by 0.062, and we come up with $53.32. We also have another FICA tax, Medicare tax, and that is 1.45% of gross pay. So let's calculate that one. So there's your $860 multiplied by 1.45%, and we end up with $12.47. A little history about FICA. FICA has been around since 1937. Let's just kind of remind us of that. So FICA started in 1937, and at that time, the Social Security rate was 1%, pretty small amount. Look at now, the FICA is a total of 7.65, 6.2 of it for Social Security, 1.45 for Medicare, but originally it started at 1%. Believe it or not, Social Security, Medicare didn't exist then, so Social Security FICA back in 1937 also had a ceiling. And the ceiling was $3,000. So if you were to do that math, that would end up being a total of $30 that any employee would pay in 1937 for Social Security. Kind of crazy, huh? And believe it or not, that stayed in vogue for 3 years, and then in 1940, the rate of 1% would end up increasing by 0.5%. So if I were to go through and do some calculations here, 1.5% on the first $3,000. Then this was in 1940. In 1943, it was supposed to go to 2%, again on the first $3,000. By 1946, it was supposed to be 2.5% on the first $3,000. And by 1949, it was supposed to cap at 3%, again, based on the first $3,000 earned by the employee. So at the most, what was paid, if you think about this, 3,000 times 3%, $90. And in all those other ones, here are the calculations. Let me just clean this up a little bit here. So you can see that by 1949, the most anybody would pay towards Social Security would be $90. So kind of crazy that that's the case. And you know that currently for 2017. Does anybody have any idea what the ceiling is? Believe it or not, when they created this law back in 1937, they said that this is the most you will ever have to pay. That was the quote. That's a quote from the end of the bill that was created back in 1936, went into effect 1937. But unfortunately, they changed the law once they realized that not enough money is going into people's retirement accounts to help them survive. So they slowly started increasing the rate and they slowly started increasing the ceiling. So here we are in 2017. Social Security ceiling is 6.2%, and the ceiling, did anybody have a chance to look it up while I was speaking? If you looked it up, you discovered that it's 126,000. That's what it is currently. So let's see if somebody makes 126,000 or more, the most they would pay in Social Security in 2017 is now $7,812. Keep in mind, we also have Medicare, and Medicare in 2017 hasn't changed since it was introduced in 1992. Medicare is 1.45%, and there is no ceiling with Medicare. So no matter how much you make, your money that you make is completely taxable. So the only escapable income tax that employees have, or I should say wage tax that employees have, is Social Security. So if you make $50,000 a year, you're paying 6.2% of that 50. If you make $100,000 in 2017, you're paying 6.2%. If you're paying 126,000, you're paying 6.2% of that 126. If you make more than 126, let's say you make 150, only your first 126,000 is taxable. So the people that are rich in our world, well, they stop paying Social Security tax as soon as they hit 126 for the year. And then they stop paying Social Security tax for the rest of the year. So, we keep hearing that Social Security is going to be defunct or empty within 20 years. Originally, the projections were, if you go back to the 1980s, the projection was in the 2020s, Social Security would be empty. Now they have revised that projection and they're thinking somewhere in the 2030s or 2040s that Social Security will be emptied. Well, in my 30 years of teaching accounting and payroll, no one has listened to me, but if they want to help Social Security, eliminate the ceiling. You see that 126? Get rid of it. It may end up being just a band-aid at this point, but you know what? All our rich athletes and our entertainers and most likely politicians, most of them make more than this. So if we were to tell them, let's get rid of the ceiling, that would end up meaning less money in their pocket at the end of the day. So chances of that changing are probably slim to none. But if anybody's out there listening, definitely let's change that ceiling to eliminating the ceiling completely. If there's no ceiling with Medicare, there should be no ceiling with Social Security. So we should not give any tax breaks anymore when it comes to Social Security. We all understand back in 1937 that we weren't even a decade out of a depression. And at that stage, it made sense to kind of spin the fact that, hey guys, I know you don't want to hear about a new tax, but this is something that will benefit you, when you retire, but we'll put a cap on it. Only your first $3,000 is taxable. So, that was acceptable to the American public at that time. But now it's getting ridiculous. Social Security, think of a bathtub, that has the drain, a bathtub that's full of water and the faucet is running and somebody pulls out the drain, right? Well, when you pull out that drain, the water is going to drain, right? And the money that's coming in is like the water coming out of the faucet. Well, unfortunately, the drain hole is very large and the water is emptying a lot faster than it's filling. That's what our Social Security system is like right now. So we need to figure out a way to open up that faucet a little bit more to compensate for that drain of the money. So My suggestion is to all the people out there that have any say when it comes to Social Security, fight for eliminating the ceiling. That will prolong the life of Social Security. Nothing else, unless they want to raise the rate in addition to that. But they need to eliminate the ceiling. Okay, so got that off my chest. So now another thing that could come out of someone's paycheck other than income tax, Social Security, Medicare, you could have things like union dues, you could have, medical insurance, 401k, charitable contributions. Any of those things could be in addition to what we have here. So let's just throw one of those in there. How about we have medical insurance, and let's just make that 50 bucks per week. Depending on who you work for, that's a good deal or a bad deal. We could also have, how about United Way, a donation there. And let's say this employee donates $2 every paycheck to the United Way. Okay, so from this information, we're now going to add up all of our deductions. And let's see. Oops, I did that wrong. Equals minus sum. Let's add them up. There we go. The deductions end up totaling $208.79. So let's label that total deductions. And now let's figure out what our employee's net pay is. So if we take $860 and we subtract out that 208.79, this employee ends up with a net pay of $600.21. Okay, so this is very important information because from this information, this is going to enable us to do our journal entries. Okay, and let me just put this back in green here. So now let's go ahead and do the journal entries that are connected with this information. So the first journal entry we're going to check out is the one for the employee. Okay, so as the this is a weekly scenario in this particular case, but people get paid semi-monthly, bi-weekly, monthly. There's all different types of scenarios out there, but our situation is weekly. So if this is like the beginning of January, let's say this is January 7th, okay? When you go to do this journal entry, you are going to debit either wages expense, salaries expense, something called payroll, maybe a combination of salaries and wages. In our situation, we have an hourly employee, so the appropriate term to use is wages expense. If we had a salaried employee, we would use salaries expense. So let's debit wages expense. Let's make sure you realize this is a journal entry. So let me write debit and credit above these two columns. And the amount that you're going to debit wages expense is always for the gross pay. So $860. That's such a major, major term and number. And now what we're going to do is we're going to credit all of the deductions. So federal income tax, and we're going to attach the word payable to all of our deductions. So federal income tax payable. Again, if we were dealing with a state that had state income tax, we would have another line here called state income tax payable. But we're just focusing on federal. So we got FICA, Social Security tax payable. And again, the reason why we are attaching the word payable is that the employer is taking the responsibility of paying this on behalf of the employee. So before the employee even gets this money, it's already out of the employee's paycheck. The government's not going to take the chance and say, hey, you employee, you pay your own tax. You know how many people probably would blow that off or wouldn't do it? So the money is taken out of our hands before we even have a chance. So this becomes a liability to the employer, and now the employer will eventually have to pay it off. So again, we got medical insurance payable, and this one is for $50. And finally, the last one is the United Way payable. And that one is for $2. And then in this last step, we will either credit cash. If the employee ends up paying the payroll on the same day, they will credit cash. If the payment of the payroll, let's say, doesn't happen until tomorrow, then they will credit wages payable. But the amount that goes in here, whether it's cash or wages payable, is for the amount of the net pay. So that's going to be the 651.21. Okay, and just as a reminder, our first line was for our gross pay. Okay, so this is what our journal entry looks like. The employer will actually do this journal entry on behalf of the employee data. So this would be to record the employee payroll. So that's the entry that would happen. So now let's say it's the next day. Well, actually, let's go ahead and, well, let me show you what the journal entry would be when we pay off that payable. Let's just pretend it's on the same day. And then we want to get rid of the payable, and we're going to credit cash. And it would be for the amount of the net pay. So whatever the net pay was, 651.21, you're going to put that in the same entry. Like I said before, if they were paying it at that very moment, they would have just skipped the second journal entry and just put cash in that wages payable spot. But as you can see here, doing it in two steps, you can tell that the wages payables just basically cancel each other out anyways. Okay, another entry that would happen on January 7th is what the employer is responsible for. So not only does the employer have to pay the employee and record all of those deductions and then eventually pay those taxes on behalf of the employer's got his own problems. So the journal entry that the employer would make is they would debit something called payroll tax expense, and the amount that goes in here at this very moment is a mystery. We don't know what this number is. It's dependent on what our credits add up to. So we'll leave that kind of blank. But a couple of things that you should know is that back in 1936, when they made that Social Security law, do you know that they said whatever the employee pays in Social Security, the employer has to match it? Yeah. So if you were wondering, how could, Social Security be going down the tubes, knowing now that the employer has been matching it since 1937. So that bathtub that you were picturing before that I was describing, imagine it being a double bathtub, a double wide bathtub, and it's still draining at a ridiculous pace. So not only are employees putting into the Social Security system since 1937, the employers have been matching it dollar for dollar, penny for penny since 1937. Kind of crazy. So the employer has to also match whatever the employee paid in Social Security and Medicare. And there are a couple of other taxes that the employer has to deal with that the employee does not, and that is FUTA tax and SUTA tax. If you're wondering what those mean, federal for the F in FUTA, state for the S in SUTA, but it represents unemployment. So federal unemployment and state unemployment. The letters actually stand for Federal Unemployment Tax Act, and the SUTA stands for state. Oops, I didn't want to put it like that. That's okay. State Unemployment Tax Act. Okay, that's weird that that did that. And in case you're wondering what FICA stands for, it stands for Federal Insurance Contributions Act. And just a couple of things when it comes to FUTA and SUTA. For FUTA, it's a fixed value, fixed rate, and the rate is 0.8%. 0.8% to calculate FUTA. And then for SUTA, it is variable, and it depends on what state the employer is in. So just for the sake of argument, let's just make it 5.4%. But understand that this number is actually variable. We would base both of these percentages on the gross pay. So we're going to take the gross pay, multiply it by the rate, and you can see that we get a very small number. Again, take the gross pay, multiply it by the rate, and we come up with, in this case, 46.44. So I now have 4 credits. I need to add these 4 credits together, and that will give me my debit. So let's add them up. And now my debits equal my credits. So for this one employee who makes $860 gross, the employee is paying out of pocket $119 just in taxes, just in payroll taxes for this employee. In addition, the employee is getting paid $651 from the employer. Now the employer also has to pay these taxes. So imagine there's 1,000 employees, 10,000 employees. You can imagine what kind of expense this is on a weekly basis to the employer. And by the way, there are ceilings associated with FUTA and SUTA. The ceiling for federal FUTA is $7,000. So the first $7,000 that an employee makes, that is subject to unemployment for the employer. So once an employee goes over $7,000 for the year, the employer stops paying the FUTA tax. And the SUTA is variable, and so is the ceiling. It depends on what state you live in, whether or not the ceiling matches the federal or is higher or lower, that sort of thing. Okay, well, we've seen some data on payroll. We calculated regular pay, overtime pay, gross pay. We figured out deductions, and then we calculated net pay. From that information, we then did 3 journal entries. First journal entry was to record the employee payroll. The second journal entry, we were dealing with paying off the liability that we created in the first entry. And then the third entry, basically this one was to record the employer payroll taxes. Okay, I hope this helped, and we'll be doing another video very shortly on some other information associated with accounting principles. You guys have a great day, and we'll talk to you next time. Take it easy. Bye-bye.